Welcome everyone to the Urban Catalyst and Armanino top 25 most asked questions about opportunity zones and opportunity zone funds. I'm Erik Hayden. I'm the founder and president of Urban Catalyst. We are an opportunity zone fund doing ground up development projects here in downtown San Jose, California. And joining me is Nick Gibbons from Armanino. Nick is a partner at Armanino Tax Practice with over 17 years of public and private accounting experience. Welcome, Nick.
Thanks, Erik. It's always great to be with you and talk about opportunity zones. Good to see you.
Good to see you too, Nick. We're going to jump right in and start off with these top 25 questions. So our first question, the Opportunity Zone program is new. Can you describe when it was finalized?
Sure. So yeah, it's relatively new, but in reality, it was part of the 17 Tax Cuts and Jobs Act signed by Trump in late 17. Although it's new, it's really important to state that it's been finalized. There were 3 rounds of regulations throughout, between 17 and 20. But at the end of the day, at the end of 19, we got final rules, or the final opportunity zone regulations. So although it's a relatively new program, it's pretty clear now how you take benefit from it.
Nick, what's interesting and what we've seen really out there in the opportunity zone world is that prior to the December 2019 final guidelines being released by the Treasury, the IRS, there wasn't as much velocity into opportunity zone investment. But after those guidelines came out, we saw a significant increase in the velocity.
Sure, because it was pretty unclear in the beginning. And it's funny. If you look at the Internal Revenue Code, section 1400Z-2 is really, it's like 2 pages. It's like nothing. And then when the regs came out, more questions were asked, because it's not super simple, but thankfully we are there now. We know how to adhere to the rules and take benefit from this really incredible program. We'll talk about this later, but again, this is probably the most generous code section, I think, in the history of the Internal Revenue Code. But we'll talk about that later.
So, can you tell me how long the Opportunity Zone program is going to last?
Yeah, so it's running. It's a 30-year program from the 17 Tax Cuts and Jobs Act. So it's going to last till 2047. However, that said, you need to invest in what's called a qualified opportunity fund like Urban Catalyst by the end of 2026. So you get your investment in by 2026, and technically this program lasts for another 26 years.
So in order to receive the tax benefits associated with the Opportunity Zone program, you have to invest capital gains. Can you describe some of the differences between capital gains and ordinary income?
Sure. So ordinary income, that's pretty easy to understand. That's when an employer pays you. Those are wages. So when you work and you receive wages, that's ordinary income. If you have something, you have property, say stock or Bitcoin, a car, and then you sell it, then that's a capital event. And if it's in the money, if you were lucky enough to buy Bitcoin last year at around 7,000, and today it's around 60,000, and you sell it today, then you have a capital gain of $53,000. Same with stock. If you're in the money in Tesla or Apple or whatever, that's a capital gain. If you sell a business, that's a capital gain. So that's the big difference. So wages, ordinary. If you sell something, that's capital.
Is there a reason why the government chose capital gains for the Opportunity Zone program?
Yeah, absolutely. I mean, this whole program was it was a brainchild of Sean Parker, the Napster guy, and what. So the reality is there are, I don't know, trillions of unrealized capital gains just sitting out there. And so what his idea was, and it was later made into law, um, was to get some of that wealth into census tracts in need, and those census tracts became opportunity zones, such as the census tracts that you guys are building projects in. And so the whole idea was to try to get some of this wealth into those census tracts, into those areas that could really benefit from. So the whole idea was a win-win, like get some of those gains out of people's portfolios into a new investment, give those individuals that had those gains a break because they're doing this, because they're investing. So that's why. Long answer, but in other words, you could think of it as we're putting capital gains into these areas so you can increase wages, you can increase ordinary income of those people in those census tracts. Does that make sense?
Yeah, the way that we look at the program here at Urban Catalyst is this is a way to get people to take capital gains, unrealized capital gains off the sideline,
Yeah,
and funnel it into these lower income census tracts, really to create a positive social and economic influence in that area.
absolutely. Yep.
Mhm. Next question. Do I have to invest all of my capital gains into one opportunity zone fund?
No, you don't. So let's just walk through an example. Let's say you're $1 million in the black on with some Apple stock. So you bought $1 million worth of Apple stock a couple years ago. Now it's at 2 million. So you have $2 million of Apple stock. You sell it, you get the $2 million. You have 1 million of capital gain. Now you can decide to invest all of it, the entire million. You can invest the entire 2 million, but you can invest whatever amount you want to from that gain. And another reason why this is, in my opinion, better or more flexible than, say, like a Section 1031 transaction is because in a 1031, in the example of the 2 million, you would have to transfer the entire 2 million over to the next property. Whereas in the opportunity zone rules, you can take that million basis off the table. So you're getting that $1 million back, and then the other million gets invested into the new investment. But you can invest any fraction that you want to of that billion in profit.
That is some nice flexibility that the program has. What are the most common ways that people have a capital gains event?
Well, around here, around the Bay Area, and probably just generally around everywhere is sale of stock. So if you've made money in the market, and a lot of people have since the pandemic last year, odds are you are sitting on an unrealized capital gain. And so this program is just an opportunity. It's a strategy to lower and defer your taxes, and then also provides an incredible incentive to make another gain 10 years from now tax-free.
So the sale of stock, and you talked about 1031s and the sale of property. Any other ways that investors can have capital gains events?
Yeah. So if you sell a business, say you have been very, very successful in growing your business, and it's time to sell, then that would be considered a capital gain. If you sell real estate, that's a capital gain.
What about cryptocurrency?
Oh yeah, crypto. I mean, and I think I mentioned this earlier, but If you were lucky enough to buy Bitcoin last year, which I wasn't, and it's so funny, Eric, I wrote myself an email saying, no matter what, even if your wife doesn't let you, find a way to buy a few Bitcoin. And of course, I didn't follow my advice, but those that did are sitting on an enormous unrealized capital gain today. It was like around 7 last year. It's like almost 60 today. So that the IRS defines cryptocurrency as property. So any sale of crypto is a capital event.
Awesome. So it's any type of capital gains is eligible for an opportunity zone. It's not only the sale of stock, but also the sale of a business, the sale of real estate, the sale of cryptocurrency, and it's both for short-term and long-term.
Yeah. I was just going to mention that, Eric. It's both short-term and long-term. Doesn't matter. Any capital gain. You could be a day trader and make $1 million in a day, and that would qualify as what's called an eligible gain in this program.
So when I invest into an opportunity zone fund, do I still have to pay taxes on my initial capital gains event?
Yeah. So and this is important because some people, when this program, these rules are explained to them, they get confused. They say, well, wait, I have to pay tax. And so it's simple. So you have your capital gain. You invest in an opportunity zone like Urban Catalyst. You don't need to pay any federal tax on that investment today. You get to take advantage of the first benefit, which is you get to defer paying that tax until your 2026 tax return is filed. So you end up paying capital gains tax on your investment of that original capital gain, but it's deferred until 2026. The tax-free capital gain comes after, as that investment, that capital gain is invested in an opportunity zone fund. 10 years from now, then when you sell that, that's tax-free. That's federally tax-free.
So you mentioned that the deferral of paying taxes on your initial capital gains event is till you pay your 2026 taxes, which typically is what, like in April of 2027?
Yeah,
and if that's the first benefit, maybe you could just run through the 3 major benefits associated with investing into an opportunity zone program.
Yeah, so again, the first one is you get to defer your tax bill on your capital gain that you're going to invest in the fund. So that's the first benefit. The second benefit is if you invest in an opportunity zone fund by the end of this year, 2021, you will then get 10% off. It's technically it's phrased differently, but it's a 10% discount on that gain. So, for example, in the Apple example, you invest $1 million of your gain into Urban Catalyst, and then on your 2026 tax return, instead of paying capital gains tax on $1 million, you pay it on $900,000 because of that 10% discount.
If I owed, say, like $100 in taxes, does that mean I'd only have to pay $90 in taxes?
Yes, that's how it works. So that's the second benefit. It's probably the most I don't want to say insignificant, but it's not insignificant. I mean, it's the smallest, in my opinion, of these benefits. Mm-hmm. Which gets me to the biggest benefit of all, which is after that investment, that capital gain that you invest into an opportunity zone fund like Urban Catalyst, after that sits there and marinates and grows, and after 10 years you sell your interest in Urban Catalyst, then that is completely tax-free. That's completely federally tax-free. So that is by far the biggest benefit of this program. It's sort of like a Roth and a 401k, all rolled up into one. It's really an amazing opportunity.
So let me just recap the three main benefits you just mentioned. The first is you don't have to pay taxes on your initial capital gains until you pay your taxes in 2027. The
Yeah.
second is when you pay your taxes in 2027 on that initial capital gains event, you get a 10% reduction. And then the third is after an investor's money seasons in an opportunity zone fund for 10 years, all of the profits from the fund itself are tax-free from a federal capital gains perspective.
Yep, you got it.
All right. So are all opportunity zone funds real estate development funds like Urban Catalyst?
Well, most of them are, but no, not all of them are. In fact, one of the reasons why they wanted to, get this program going was the idea of moving businesses outside of just real estate funds into these zones. So they can be set up as qualified opportunity zone businesses or QASBs, but yeah, I mean, the short of it is no,
I love
not
that
all.
term, QASB. What a great term.
But most of them are, Eric. I mean, it was really leveraged. This whole code section and the rules were really leveraged from Section 1031, and then that's in the world of real estate. So, and it was just very logical to set up these real estate funds and invest in these areas. I mean, that's what you see again and again.
Just to reiterate, Nick, we talked about the three primary benefits associated with an opportunity zone fund, but could you just go over what is the biggest benefit associated with investing into an opportunity zone fund?
Yeah, the biggest benefit is when that investment appreciates over 10 years and then you exit that investment. That then is federally tax-free. So today's capital gains rate for Fed is 23.8%. So let's just say that you invest $1 million in the Urban Catalyst, that $1 million grows fivefold 10 years from now. So when you sell that $5 million worth of fair market value of your investment, all of that comes back at zero tax for Fed purposes.
That is quite a benefit, isn't it?
It's huge. I mean, it's 23.8% on top of your rate of return.
That's amazing. So we all have heard that you have 180 days from the date of your capital gains event to invest into an opportunity zone fund. Yeah. Why did the IRS have this 180-day deadline?
Well, I think it's because they just copied the language of Section 1031. But if you think about it, it's a meaningful amount of time. It couldn't be over a year because that's just another benefit. And it's just a meaningful amount of time that you get in order to identify an opportunity zone fund after you make the sale or after you trigger the capital gain.
Mm-hmm. And just to clarify again, this program, the Opportunity Zone Fund program, is good for both short-term and long-term capital gains events?
Yeah, absolutely. So if you're a day trader and you make $1 million off some crypto, you sell it, and that's definitely a short-term gain, but it's also an eligible gain that you could invest in an Opportunity Zone Fund.
Can you describe briefly the difference between a short-term and a long-term capital gain?
Yeah, super simple. Short-term is any gain that's less than a year. So if you hold property and sell it within a year, then that's a short-term capital gain. Everything else longer than that, that's a long-term capital gain.
And what are the different tax rates for short-term and long-term capital gains?
Good question. So the short-term, a short-term capital gain is taxed at your marginal tax rate. So if right now the maximum tax rate for individuals is 37%, whereas the long-term capital gain is taxed at the capital gains tax rate, which is 23.8%.
So definitely really great part of the program for short-term capital.
Oh yeah, I mean, absolutely. You've hit the nail on the head. I mean, think about it. So you get to defer something that you would have to pay 37% on, right? So you have $1 million gain within a year, short-term gain. If you sold that now, $370,000 of that $1 million of gain goes to the government, goes just to the federal government. Whereas this program allows you to defer that, first of all, until 2026. And then you get the other benefits that we discussed. But yeah, it's really a great idea, a great play to invest short-term capital gains.
So why is the Opportunity Zone program so popular with investors that have a capital gains event from the sale of stock?
Well, I mean, I think it's so popular because there are so many of them. I mean, the market has gone up tremendously over the last 3 to 5 years, longer, and there is just a ton of unrealized gains in the stock market, and so people don't like to pay taxes, and I don't either, and this is a good way to offset or defer both those capital gains from stock.
We see here at Urban Catalyst, at least in our first fund, that over 70% of our investors, the sale of stock was their capital gains event. And a lot of them mentioned to me that, well, it's really into two camps. It was they're day traders, they're sick of riding the roller coaster that is the stock market, and they want to diversify their portfolio, but they don't want to pay taxes. And so diversifying into real estate through an Opportunity Zone program gives you some tax benefits and puts you into real estate. Really, the other category that we saw a lot of folks that say work at one of the large tech companies, they've had stock options for years and years. And now the majority of their net worth is tied up in their primary residence and in the stock of their company. And they've always known that they need to diversify. Nobody says, yes, invest all of your money in one stock. But taking that tax hit has made it so they haven't made that choice yet. And now that Opportunity Zones have come around in this program, it's really the first time there's ever been a safe harbor for those investors to diversify their portfolio into real estate.
Yeah, you said it perfectly. That's exactly the case. It's diversification into real estate in this opportunity fund, Urban Catalyst. And you don't want to have all your eggs in one basket. And there's been a ton of appreciation of tech stock in this area. And it makes a lot of sense to, protect your overall net worth this way. And in doing so, also not paying as much tax as you would. And
so here at Urban Catalyst, we're structured, at least our fund is structured as an LLC. There are a lot of other Opportunity Zone funds out there that are structured as real estate investment trusts. People call those REITs. Could you talk about, as a tax expert, could you talk about what is the main advantage of utilizing an LLC structure for an Opportunity Zone fund? Versus
well, the reason, and it's a good reason, you guys set it up right the first time. I don't understand why anybody would set up a REIT as an Opportunity Zone fund. And the reason is because you're an LLC, checking the partnership box allows you to pass along profits, and most importantly, a depreciation to your investors, to the partners of the LLC. So as you acquire these projects, these buildings, you get to take depreciation expense, and you can pass that through to your investors. Whereas in a REIT, that doesn't happen. It's just everything's ordinary.
So in a REIT, if they take the depreciation on the buildings, they don't pass it through to the investors, who does that depreciation go to?
Well, it goes to the REIT company.
So
And
what you're saying is the opportunity zone funds that are structured like a REIT, they get to keep all of that depreciation themselves. It's almost like an extra fee.
absolutely,
Mhm.
100%.
And
And
then what about the distribution of um, refinance proceeds to investors? Can you do that with a REIT?
no,
So, here at Urban Catalyst, one of the big things that we're able to do is when our projects are built and stabilized, we're going to go out and get permanent financing and refinance them. And then excess refinance proceeds, we plan on passing those through to our investors tax free.
yeah,
And you're saying I couldn't do that if I was structured as a REIT.
that's correct.
And
So
then I also wouldn't be able to pass through losses, which are pretty significant throughout the duration of the 10-year hold. I can't pass those through if I'm a REIT.
yeah, which is why would you set up an opportunity zone as a REIT? Again, that's just a really unwise, unwise decision.
Nick, can you talk about the three major advantages to structuring an opportunity zone fund as an LLC?
Okay, yeah. So because Urban Catalyst is a real estate fund and structured as an LLC, you get three additional benefits to the benefits that we've discussed in the Opportunity Zone program. And so those are tax benefits associated with the Opportunity Zone program that we discussed. Two is the tax benefits associated with the structure of an LLC, which is passing through tax-free distributions via debt refinancing, passing through depreciation, getting those passive losses passed through, which in my opinion is probably the second biggest benefit of all of these benefits, if you think about it. And then just the tax benefits associated with ownership of real estate. So it's this is the beauty of Urban Catalyst. You are able to get all of the benefits of the Opportunity Zone program, and you are able to take advantage of all of these benefits, utilizing every tax benefit associated with different structures. So it's really the home run, the tax home run in the Opportunity Zone world is this structure. And if you're investing in the right census tract, then it's a grand slam. Because not all census tracts are created equal. So you need to find good property that would appreciate anyway. But then if it's in an opportunity zone structured as an LLC like you guys, then it's going to be pretty hard to screw it up.
So you mentioned depreciation as being one of the almost like secret benefits associated with the Opportunity Zone program. Depreciation, obviously, it's extremely common to take depreciation on all different types of real estate investments. Can you tell us what is this depreciation, how depreciation works, and then specifically about how depreciation recapture is treated in a typical real estate investment versus an Opportunity Zone fund?
Sure. So depreciation, just, think of it as you buy a car, and as soon as you take the car off the lot, then it's, goes down in value. That reduction in value is called depreciation. And there are, specific lives of specific assets in the Internal Revenue Code that allow you to depreciate expense.
So you talked about depreciation as one of the major benefits associated with the Opportunity Zone program. You even said it's one of the largest benefits, almost like a hidden benefit.
Yeah.
We all know that depreciation is extremely common in all types of real estate investment and ownership. Could you talk a little bit about, how depreciation works, and really when you sell an asset, when you just a typical real estate asset, how depreciation recapture works versus how it works in an Opportunity Zone fund?
Sure. So depreciation is just the expense of an asset that gets depreciated. So the most simple example is a car. You buy a car, you take it off the lot, the car loses some value. That loss of value is depreciation. In real estate, even just think about your house. Your house, is depreciated over time, the actual structure, not the land, but the house itself over 27 and a half years. And so in a normal real estate investment fund, that depreciation that passes to you after the investment is sold, you get taxed on that because you've taken benefit of that depreciation. So that's the normal non-opportunity zone fund.
So
real estate fund.
So paying back that depreciation, that's called depreciation recapture.
Yes.
It happens when you sell your real estate asset in a typical real estate fund or investment.
Yes. So that's how it's typically treated. However, when the final regs came out in 19, the final opportunity zone regs, when those came out, they took that out. So you have this, which is why I think it's probably the second biggest benefit. You do not have to take a depreciation recapture. You do not have to pay for that depreciation that you've had benefit on. So that's a very significant benefit. No depreciation recapture in opportunity zone real estate fund.
So what you're saying is that, for example, here at Urban Catalyst, when we sell our assets after 10 years, we've distributed depreciation over the life of those assets to our investors, and they don't have to pay that back. They don't have to pay taxes on that. Yeah. So not only do they have tax-free profits, but they don't have to pay back the depreciation. What happens to that depreciation?
Well, you get to have it to offset passive losses during the time that you're in the investment. But the beauty comes when you sell the entire investment of Urban Catalyst. To the extent that you have that depreciation, you get to offset ordinary income. It turns into an ordinary loss, which is a really significant benefit.
So what you're saying is that this depreciation is passed through to our investors as passive losses, and those losses carry forward. They can use them to offset other passive income throughout the life of the 10-year hold. Yep. But then when we sell our assets, not only do they get to keep all the depreciation, but that passive loss converts to active loss and can offset things like ordinary income.
Yeah, that's exactly right.
So a very important part of the opportunity zone strategy here at Urban Catalyst is for us to refinance our assets and distribute those refinance proceeds to our investors. I mentioned that we don't anticipate those distributions being taxable. Can you talk about that and why the program is set up that way?
Sure. So first of all, think of this whole concept of the debt refinancing distributions as a home equity line of credit on your house. It's if you borrow money against your house, that's not taxable. Well, in this situation, it's the same thing. Technically, you're getting basis when the debt gets refinanced and that gets passed through to the investor. So that's why those distributions are not taxed. They're a tax-free distribution because of the debt refinancing that creates the basis.
Because isn't it the way that it works is, how investors, the reason they don't have to pay their taxes until after 2026 is because when they invest into an opportunity zone fund, what happens is the IRS doesn't recognize any basis. And in fact, what happens in 2026 is there's a step up in basis, and they get that 90% step up. That's how you get that 10% discount. But what is really happening here is we're able to distribute refinance proceeds to our investors, and it's tax-free. And you're saying it's tax-free because it actually creates a basis?
Yes, it's tax. It's just you're just getting some of your investment back via the debt. Just try to think of it as it's just a home equity line of credit, and to the extent that you borrow against that, those distributions that come back, those are not tax. That's not a taxable transaction.
What would happen if I was able to refinance my projects and distribute more than 100% of my investors' initial investment back to them through this tax-free distribution? Say I could do 110%. What happens?
Well, anything over your basis, anything over the 100% will be treated as a taxable distribution. So you can't do a tax-free distribution over 100% of your investment.
Well, the good news for our investors is we don't plan on distributing more than 100% of their initial investment back to them through the refinance, but definitely something to keep in mind, especially if the market takes off here in the next couple of years as we build our buildings.
Absolutely.
A lot of our investors have other investments, of course, and they're getting multiple K1s per year. Can you talk about what a K1 is, and when that tax comes due for their original opportunity zone investment, what happens if they have other capital losses that they've incurred?
Yeah, so K1 is simply a form that's sent to you and the IRS, basically reporting the income and or loss that you earn on your investment. If you're a partner of a fund, you would receive a K1. Just as if you were a consultant, you would receive a 1099. 1099 goes to you and a copy goes to the IRS. It's how the IRS tracks income throughout the country. So a lot of your investors will have multiple K1s. The nice thing about Urban Catalyst that we've talked about before is you'll just get one K1 with all the projects listed because it's all in one state. Now, to the extent that you have other losses from other K1s, those can offset other passive income. So you make money on some property in Southern California, but you have a big passive loss on another investment via K1, then that gets to offset, the loss gets to offset that income.
So why that would be important to Urban Catalyst investors, we plan on passing through a significant amount of losses because of the depreciation on our buildings. And so what you're saying is they would be able to utilize our passive loss that we're passing through to offset other types of income that they might be receiving from other real estate investments or investments in businesses.
That's right. And it's also important to note that to the extent that you have unused passive losses, those get to be carried forward forever. And then, as we discussed earlier, when you exit or when you sell the entire investment, that turns from passive into ordinary.
Oh, in an opportunity zone fund.
Yeah.
What are some of the recommendations that you're providing to your clients who have a capital gains event from the sale of stock?
Well, if you think about it, there are not too many options to offset or to plan around a capital gain. There really isn't. And so one of the biggest benefits of the Opportunity Zone program was to provide an incentive to get this wealth into these census tracts. So if I have a client that's is looking at a huge capital gain, oftentimes, well, almost all the time, I inform them about the Opportunity Zone program. Some people take that advice. Some people, search for a good Opportunity Zone investment and just don't find it, but others do. And it's just a really good way to defer, to reduce, and to make a gain tax-free over time.
So Nick, a lot of our investors in our first fund, their capital gains event was from the sale of stock.
Yeah.
Many of them come from some of the large tech companies around here, they have stock options. Can you describe some of the differences and the different types of stock options that people receive when they work for companies, and which ones are eligible for capital gains and investment into opportunity zone funds?
So there are, in my mind, roughly 3 different ways that you receive stock options or just stock from the company. One is the incentive stock options, ISOs. That's typically a right that's given to an employee to buy stock at a lower price than it is at the time. Usually it's set up as the same price as the fair market value and the day that you exercise the incentive stock options. And then there are non-qualified stock options. Those are typically given to a lot of employees, not just the founders or the executives. So these are more common than ISOs. It's the same concept. You are given the right to purchase stock at a fixed price, and then if that stock increases, it makes sense to exercise and buy that stock at the lower price, which was fixed at the time that you were granted this option, this right to buy stock. And then the third way is receiving restricted stock units, or RSUs. And this is the most common that we see here in the Valley, where you get a fixed amount of RSUs throughout time. So usually it's quarterly. From what I've seen, say you get 100 RSUs, or you get 100 restricted stock units a quarter. That is another way that you receive stock. So, but going back to your question, how are these treated, and how is this associated, and how can you take advantage of these, of the ways that you receive stock in order to invest in an opportunity zone? So the first two, the ISOs and NSOs, non-qualified stock options and incentive stock options, you buy that, you exercise the right to buy the stock, you hold on to that stock, the stock appreciates, you sell it, that's a capital gain. The RSUs, when you receive them, is income, because the company is giving you straight the stock, is injecting stock units into your portfolio. But if you hold on to those RSUs, those options, or I'm sorry, the stock, and that goes up in value, well, and then when you sell, that turns into a capital gain.
Got it. So really, all 3 different ways a capital gains event could have been created, and therefore they're eligible to invest into an opportunity zone fund to shelter their taxes.
Yep, exactly.
So as we know, the IRS set the program up so that you only get that third key benefit, those tax-free profits, after your money has seasoned in an opportunity zone fund for 10 full years. Do we know exactly why the IRS, what was their reasoning for making investors wait 10 years?
Well, I don't think we know exactly why, or maybe someone does. I do not. However, my theory is that it probably follows the same time period that census track, or that census is updated. So last year, the census was updated, and 10 years prior was the old census. So it's a meaningful amount of time. It's a decade. You want to have enough time to really measure the impact of the opportunity zone investment. So they set it at 10 years, and it makes sense. I mean, this is a program that is intended to help to grow economically these census tracts in need of wealth, of investment.
So it makes a lot of sense to us here at Urban Catalyst that there's a 10-year holding period, mainly because it really works well with real estate investment. I mean, obviously, real estate is a longer term type of investment than, say, investment into stock or bonds or other types of investments. So having a 10-year measuring stick or a 10-year investment program in a certain area Not only does it match up with the long-term plans of real estate, but it also matches up with the government wanting these investors to be invested in these lower income areas for a significant duration of time, not only to measure the impacts, but to create those impacts.
Absolutely. That's exactly right, Eric. I mean, it wouldn't make sense for this program to say 2 years. 2 years isn't enough time. 5 years sometimes isn't enough time. And 10 years it's a meaningful amount of time. It's not forever, but it's a long enough for you to see the fruits of your investment into that census tract of need.
So here at Urban Catalyst, as you know, Nick, our fund is based in downtown San Jose, California. And we know that California doesn't conform with the federal program. There are a bunch of questions our investors always have, specifically revolving around if they live in California and invest in a California Opportunity Zone fund, or if they invest in one out of state, or non-residents that invest into a California Opportunity Zone fund versus their own state. So let's break that up into smaller pieces. So if you live in California and you invest into an Opportunity Zone fund, what happens?
Well, you get to take advantage of the Opportunity Zone program for federal purposes, but you will be paying the tax on your California income tax return because California doesn't conform. It's one of the 3 states that does not conform to the program.
And that's if you invest into a California Opportunity Zone fund or any other state. You still
any Opportunity Zone fund anywhere. If you're a California, you're paying the tax in which you invest.
And then at the end of 10 years, when we provide those federal tax-free profits from the sale of our assets, if you live in California, you have to pay California taxes on that?
Yeah, assuming that they by then do not conform, then yes, you'll be paying California tax on the exit. So if you're California, you're paying tax in and out. If you're outside, yeah.
Is that also, so if you live in California and invest into an Opportunity Zone fund in another state, not California, you still have to pay California capital gains rate taxes on the sale?
Yeah, in and out anywhere. So if you're California paying tax, it just does not conform.
So so really California residents, they're going to be paying California capital gains taxes no matter what.
Yes.
Now, if you're a resident of another state that does conform with the Opportunity Zone program, what happens if you invest into a California Opportunity Zone fund?
Well, if you're outside of California and not in Massachusetts or North Carolina and any of the other 47 states that do conform, you do not, you get to take advantage of the program going in. So you get to defer the state tax until 2026, just like for Fed purposes. Now on the exit, if it's a California investment, you will be paying tax on the exit. So if you're outside of California and you're in a conforming state, which is the majority of the country, you get to take advantage of the program in, but when you sell it, then you're paying California tax. If you're a Californian, you're paying tax in and out.
Got it. Thank you for those clarifications. It sounds like the Opportunity Zone program, in your opinion, has some pretty amazing tax benefits associated with it. When you recommend the Opportunity Zone program to your clients, what are the most important things that you look for, say, in an Opportunity Zone fund?
Well, the most important thing that I look at is, does the project make sense? Like, just don't even think about the Opportunity Zone program. Is this investment is it a good investment? Is this real estate is this project, is it going to increase in value over the 10-year period? Because if it doesn't, then all these benefits are pretty much meaningless. So I kind of look at it as the Opportunity Zone program is icing on the cake. You need to first find your cake, and then you can apply the icing. You don't want to eat something else with icing on it.
Can you go over what tax forms investors will need to submit as a part of their taxes? really to let the government know that they've invested into a qualified opportunity zone fund?
Yeah, of course. So I can explain how that works. So if you're an investor, the two forms that you will be filing, two simple forms really. The first is 8997. It's just a 2-page form. You're just telling the IRS, okay, my investment in opportunity zone is X. Pretty much it. In the first year, it's a form you're going to be filing every year that you're in the program, just informing the IRS if you're still in the opportunity zone fund or in new ones or exited any, just so they can track what the opportunity zone fund Urban Catalyst is filing. You guys file an 8996 that has all that information. It's the same thing like the K1 1099 matching, just keeping track of just all the data. So the next form is a 8949, and that's a simple form as well. It's just mechanically showing that you're not going to be paying the capital gains tax in the year in which you invest on your federal form. Does that make sense?
Mm-hmm. And do you fill that one out one time, the 8949?
Yeah, that's a one time. The 8997 is for 10 years.
Mm-hmm.
Or,
so, here at Urban Catalyst, we try to make it easy on our investors and their accountants like you, Nick. When they invest into our fund, we provide them with a receipt. It has the legal name of our LLC that is the fund. It has the federal EIN number, the investment amount, the names in which the investors invested or the entities. It really has all the information that they're going to need to fill out those tax forms in a quick and easy way when it comes time to do their taxes.
Yeah, it's pretty simple. I think my daughter could just enter that data on this form. So if you have problems though, if you need help on that form, please send me a note. I can do it for you and send you a bill.
Absolutely, Nick. Nick, last question. You've recommended several investors to invest into Urban Catalyst Opportunity Zone Fund. Why did you decide to recommend our fund over other Opportunity Zone funds?
All right. Well, let me just be clear. Like I'm an independent party here, and although I've recommended friends and family to Urban Catalyst, my clients I can't recommend. However, that said, I mean, in my opinion, it's really a no-brainer, because look at the census tract. It's downtown San Jose. Who is investing in downtown San Jose? Big tech, Google, all of them. They're all moving south, like you've have explained throughout this time that you've had the Fund 1 and now Fund 2. So it's a great census tract into which in which to invest. Secondly, you guys were on top of it from the very beginning. You guys spared no expense getting the best legal help, structuring the fund perfectly, that LLC structure that we discussed today. And you also have an outstanding team. I know your colleagues well, and it's a really an all-star cast of professionals. So you have to find a good team, you have to find a good census tract, and the projects. So it's I don't know of any other. I don't want to flatter you too much, but I don't know of any other opportunity zone fund as most likely is that's going to be as successful, I think, as yours.
Well, I appreciate you saying that, Nick. Thank you very much. So that wraps up our top 25 questions that you want to ask about opportunity zone funds. Thank you for joining us. Of course, I'm Erik Hayden, the founder of Urban Catalyst. We're an opportunity zone fund in downtown San Jose. And Nick Gibbons, my guest here, is a partner at Armanino and does some of the best tax work in the business.
Thanks, Erik.
Thank you.